Hello, everyone, and good evening. I'm so excited to bring you Attorney Barley today because after my last live, all about interest rates going up and how to approach it, I had a lot of people in the chat that were saying, I thought my mortgage was going to be, $1,300. Now with the higher interest rates, it's $1,700, and they weren't really sure how to approach it. So I wanted to bring an attorney on, and I'm going to allow him to introduce himself to answer some of your questions. So, not that he could be your legal counsel, but to give you some guidance as to what you should do next. So, thank you so much for joining me tonight. And Attorney Barley. Attorney, would you mind introducing yourself?
Thank you, Shahida. Glad to be here. My name is Tua Barley. I'm a real estate attorney with Luter, Larkin, and Hunter. I've been practicing in the real estate arena now for almost 18 years. So I know a little bit about real estate, still working on it on a daily basis, but I'm glad to be here to answer any questions that you may have. And as you mentioned, yes, things are constantly changing, and making sure that you have the appropriate documentation in place is going to be key to determine how things will end up in your favor or not.
Okay, so definitely put your questions in the chat so we can answer those questions. I know we have a few people. They said they recently pulled an offer. Let's click this one. I recently pulled an offer in April once realizing the rates were getting out of hand on top of overbidding for homes. So let's just start with this. Let's start with if they're under contract already. I'll close this out. Mm-hmm. What's the first, well, not even under contract. Before they go under contract, what should they be doing? What's your advice before they go under contract on a home in this environment where interest rates may be going even higher in the months ahead?
Well, I think the first thing obviously is to check and make sure that the loan that you qualified for beforehand, and even before you go under contract, make sure that you qualify for a loan, and check and make sure, because most lenders can give you an interest rate of what it is currently and what it'll be. So that'll kind of factor in as to what you can afford, basically, what your monthly payment is going to be, what size of home that you can afford. And I think that's going to be key, as we mentioned, because interest rates tend to be going up with the Fed changing and increasing their base rate. Just, I believe, last month or a few weeks ago, it's always constantly going up. So you want to make sure that you check with your lender as to what you can and cannot afford from the outset. And most lenders will give you a lock rate for a period of time. And so you want to make sure that period of time is going to be sufficient for you to get into a contract and have enough time for all the title issues and things that attorneys typically deal with are taken care of, so that you're able to close in time to lock in whatever interest rate that you were initially quoted by your lender.
Okay. And if you're going beyond, typically, if you're going beyond that 60-day lock, you're probably going to have to pay more in fees. And some of those fees are non-refundable. So even if you get out of your contract, you may have some issues, if you're going to basically be out of that money. So you want to make sure you understand that if you're doing these longer locks, these 90-day, 180-day locks, they're probably going to cost you some money. So let's talk about, Attorney Barley, let's talk about people that maybe went under contract, say in November. The house is not complete yet, and now they want to try to get out of their contract because they realize they're kind of in over their heads as far as costs. Mm-hmm. Now the interest rates have increased. How would you have them approach that?
All right. So the first thing about trying to get out of any contract, and as Shahida mentioned earlier and when we first introduced, I am barred in the state of Georgia. I know that there are many people online now who may be from different states. So you always want to seek legal advice from an attorney barred in your particular state. So I can only really speak to Georgia, and I can talk hypothetically about what may happen, but it's always, again, my advice to seek out counsel in your particular state. So now what we always try to do when we're trying to get out of something, in this case, a contract, we always make sure that the contract has in there a clause that allows us to do that. And so what I would say first is do your homework. So before you sign a contract, make sure that you've had an opportunity to review it. And because what we always as attorneys try to look at is worst case scenario. What happens if we don't agree? Because it's always wonderful to go into a contract thinking that we're going to agree, we're going to be able to consummate the contract and move forward and purchase the property. But really, the where things happen is what happens when it does not go through. And especially, you want to look at it from your standpoint. So if I were a buyer and I was about to enter into a contract, I need to look at the provisions and terms and clauses within that contract that says, hey, what happens if X occurs? Let's, in this case, if as we find ourselves in now with COVID and the supply chain issues and the cost of supplies going up, what happens if supply goes up? Does the builder in this case have clauses in there that tell you that your sales price may increase as a result? Now, when we first started COVID, a lot of builders did not have those provisions in there. And so it was easy for a buyer to get out of a contract because the builder would specifically say the house would cost $300,000 to build. And if the cost of supplies went up prior to that point and it happened to cause them money, at the end of the day, they would still be responsible. What occurred as things went on and COVID became more prolonged and supply chain issues became more enhanced is that the builders started incorporating into their contracts where they wouldn't necessarily guarantee a price for the home, but would tell you based on whatever their costs are. They would have to increase the price. So as a buyer, again, I would have to look at that contract and say, if the cost, what's my worst case scenario in terms of the valuation of costs going up? And if that worst case scenario was higher than I was able to afford that home, then I would either figure out a clause or a way to get out before I signed that contract, have my agent put in a clause specifically saying that this was the maximum amount of price that I could afford in a house. And so even if the cost went up to a certain degree, because I entered in that clause, I'm able to exit out and in some cases keep my earnest money. So that's what I would say. Review the contract first, figure out what your costs are going to be or what your top end in terms of your price that you're able to afford that home, and then figure out a special stipulation or add it into that clause if you can. Because in some cases with builders, it's very difficult to add in language. But again, it's easier to do it at the negotiation stage when you're early on, you haven't signed the contract, and then trying to do it after the fact.
Okay. So you definitely want to look over that contract, see what clauses are already in there. Can they increase the price? Is this price, is this price official? Is it guaranteed? Or if supplies increase, are they able to increase the price and then terminate the contract on you? And then on the flip side, if you're unable to afford the house because of interest rates increasing, you need some kind of finance contingency in there to say if interest rates reach this amount, I'm able to terminate without penalty and get your earnest money back. Either you need to have that in the contract already, or you need to try to add it in or have your agent add it in. And like he said, it is difficult for your agent to add a clause to a new construction contract. However, you need to go in this market. These are things you need to be asking for, or your agent needs to be asking for, or you may not, if you can't take the risk, because a lot of times right now, builders are asking for even more earnest money. They're asking for higher deposits because they're aware of that risk. They're aware that you can walk away. They want to make you put so much money down that you regret walking away from them. So some of these deposits are getting really, really high to make you second guess whether or not you should walk away from this deal. Some people have $30,000 in a deal, $35,000, $10,000, $15,000. So you're putting that money up with the chances that if you walk away, you're going to lose that money. So they are making you even put more money up. So if you do walk away from the deal, you would potentially lose that money. So you need to make sure you understand fully what you're getting into at the very beginning of the deal. So we have a question that's come up. Let's see this question. Can we lose our earnest money if the appraisal comes back lower than the asking price under FHA? Can we terminate the contract if we cannot come into an agreement with the builder? Can you talk about this, attorney, about the FHA?
I can. And the answer and a favorite attorney answer is almost it depends. But let me clarify that So if you were here in Georgia, and if you use what we call a Georgia Association Realtors contract or a GAR contract, that contract requires you to have an exhibit, a financing contingency exhibit or an FHA exhibit. Within that FHA exhibit, it has stipulations in there regarding the appraisal and the valuation. And in most cases, when you have that appraisal contingency in that appraisal in that loan exhibit, it does allow you, if the appraisal comes back lower than the sales price, in order to get your earnest money back. Now, if you're not using a GAR contract, or if you're in another state, well, again, I would go back to what I mentioned earlier. Make sure that if you're using a standard contract from that state, make sure that it addresses that particular scenario. So, and if you're not sure, ask your real estate agent, ask your realtor, hey, what happens if that appraisal comes back? Am I allowed to get my earnest money back? And they will point you to the exact provision within your contract that allows you to do that. Can you terminate the contract if we cannot come to agreement with the builder? Yes. If you're using, again, depending on the contract and making sure that the clause in the contract allows you to do that, then yes, because you're at this point, you have a better negotiation standpoint if you're able to exit the contract based on the appraisal being low. However, if you signed either a builder contract or a contract that doesn't have that provision, you're now in a less bargaining chip, and more than likely, the builder will not agree to reduce the cost of the price of their building to meet with whatever the appraisal cost is. And so you potentially could lose that earnest money if you haven't done the necessary homework ahead of time to address some of those needs.
Yes, and that FHA clause is called the amendatory clause. That's what you want to look for in the contract to make sure you're covered. So it's called the amendatory clause, and I have a video about it. But look for that clause. If you're an FHA buyer, you want to make sure that clause is in your contract, your finance contingency, that if the house does not appraise, you're able to walk away and get your full earnest money back. But you need to make sure that clause is in your contract.
And in line with that, and that clause has a blank form or blank space in there to put the valuation, the sales, the price at which you will not accept the value to be less than. And make sure, and this goes to forms in general, especially our GAR form, make sure that your real estate agent is filling out all blanks. Because in preparation for this, I looked at one of my contracts, and it had nothing listed in that section of the amendatory clause. And that can come back and bite the buyer in the case where the appraisal comes in lower. So you want to make sure that if there are any blanks in a contract, make sure that you fill it out so that it doesn't adversely affect you.
Okay, so make sure everything is filled out appropriately, and you need to go down. I mean, depending on how even seasoned realtors make mistakes, when you're looking at your contract and you see blanks in your contract, ask your agent, why is this blank? We need to fill this in. There should be no blanks in a contract. Should there be? Nope. There should be no blanks in a contract. So you need to make sure that that's filled out.
0 NA, there's some value that should go in there, and it's best to put one in, or else again you leave it up to whomever to make that sort of ambiguous decision.
All right, so Higher Vibrations has a question. It says, what penalties are normal if you walk away other than losing your earnest money? Can they take you to court? Well, in Georgia, I'm talking about Georgia, and in most states, I think we have in the contract, like it says, in our contract, it specifically says that the risk is you losing your earnest money to the seller. That's the only thing that they can, in the contract, it says, that's all they can come after you for. However, the agents, the brokers, may be able to come after you for commission in the contract. These things are written out. So these are things you need to look in your contract and see, okay, the seller or the builder can only get earnest money, but can the broker, the one that's either representing you or representing the seller, some of them in those contracts will say, even if you do not close, that they found you a property and you terminated on that property, they still earn their commission. So those two things you should look for, and I'll let the attorney answer it as well. You should answer, if I terminate, what is my penalty to the builder or the seller? And then what is my penalty or potential penalty to the broker on either side, your buyer's broker or your listing broker? Do you have a penalty to them?
And I think you answered the question correctly. Again, it goes back to the contract that you're using. So most standard GAR contracts, or Georgia Association of Realtors, or most states that have standard realtor contracts will say that the maximum exposure or liability is that earnest money. But let me tell you this, I'm not a litigating attorney. And so what I would say is this: most contracts, or some contracts, allow for, if the seller did something in addition to the contract that allows them to be compensated. So for instance, in a builder contract, if you ask the builder for certain upgrades or certain things that would be outside their normal spec home, and they spent additional monies to create or to add that feature in there, you could potentially be liable for that additional cost that the builder took, that they would not have but for your specific request. So yes, in short, I want you to think of the earnest money as being your sole, the sole thing that you would lose. But I also want you to understand that there could be potential or additional liability, not only to the real estate agents in terms of their commission, but also to the seller in terms of any additional costs they may have incurred as a result of having the contract with you. So again, make sure that you go back and make sure that you read that contract to understand your full liability if you were to walk away from the transaction.
Okay. Yeah, very, very important. I had something similar. Now, at least in Georgia, and you check in your state, they have to sue you. So a broker did threaten. I had a client terminate maybe a week or 2 weeks before closing. She knew she would lose her earnest money. So she did lose her earnest money that she put up. But the broker I wasn't going to sue her for my commission, but the listing broker threatened at least to sue her for her commission. And she didn't go through with it, but it's not like automatically you would have to give them the money. There has to be some kind of litigation that takes place for them to, win a judgment, I guess, that they would get their commission. And sometimes brokers don't want to go that far, but that's the risk that you face, that they could potentially sue you to get their commission back. So you just want to make sure that you understand that. And I want you guys, for the questions, I want you to stick with questions that are particularly to contracts and potentially, like in this volatile environment, some things you may face or questions that you may have with your contracts moving forward. So let's stick with those types of questions. Attorney Barley is not a lender, so he's not going to answer those lender questions. But I want you to ask any questions that would, you would seek legal counsel for, so he can maybe give you some kind of guidance in that area. Okay.
And to add on to what your final part about they'd have to sue, but understand also, if they do sue, in some contracts and in some cases, they can not only get back what they stipulate in the lawsuit. So let's say you didn't pay me $5,000, it's the $5,000. But then in addition, the winning party, so assume they win, you also may have to be responsible for their attorney's fees. And so you can see again how it could go from just limiting your damage from the earnest money to additional compensation to attorney's fees that you may potentially have to pay back.
Okay, yeah. So you want to make sure, like you said, when you're going into these contracts are very long. And I know a lot of you don't want to read the whole contract. So I recommend real estate agents do this with builders. Have the builder send you the contract ahead of time. Have them send it to you ahead of time so you can go through it. You can highlight your questions. So then when you're ready to sign it or ready to go over it, because your realtor is not your attorney, but very few, at least in some states, you don't need an attorney. So they're the closest kind of advisor that you'll have at the time. So you need to make sure you ask those questions. If your realtor is not answering your questions to your liking, then you do need to hire an attorney to look over that contract so you fully understand it. Because people are getting stuck owing earnest money or losing a lot of money because they didn't understand that they couldn't get their money back. or they couldn't easily get their earnest money back. So you want to make sure you definitely understand your contract. Ask if you're thinking about new construction or even resale, go get the contract ahead of time. So you're not just, rushing to sign it. You've actually looked at it and you know what you're signing ahead of time. Okay. So go ahead and put your questions in the chat. What would you see the mistake, Attorney Barley, do you see a mistake that most people are making now? Trying to get their offers accepted, that sort of thing. Any mistakes you see people making?
Well, I mean, the only mistakes that I'm seeing are just not protecting themselves because, with this being a seller's market, people are going out and rushing to not only offer something above listing, but they're just trying to get their offer accepted. And so sometimes they'll go 20, 30, 50,000 above and really not protect themselves if, for instance, like we talked about, what happens if the appraisal comes in? Or what happens if the loan isn't accepted for that amount? So you really have to sort of do your homework ahead of time in being able to understand, are you qualified? So, because it's great to offer 50,000 above appraisal, but if you're only qualified for a loan 20,000 above the listing price, then you're going to be in trouble when you offer 50,000. So do your homework ahead of time to make sure that in this competitive market that you're ready to sort of rock and roll. And that homework is everything from making sure that your lender is ready, because the way that sellers look at things are they want to make sure that you are ready to go and they accept your contract. And that goes back even down to the lender that you select, the type of loan that you select, and when you say that you'll be able to close. And so all of those things are taken into consideration when you're trying to put in an offer with a seller.
Okay, good. All right. So another thing that I want to make sure everybody understands is if you use one lender and say you're locked into a rate with that lender, say a 60-day lock, and rates all of a sudden they drop, right? You could switch lenders without penalty. You don't have to definitely close. Now, I don't know if that second lender can close you as quickly as the first lender. You're going to have to see that. But a lender can't hold you to close with them and penalize you financially for not, unless you paid in advance for to lock your rate. But you can switch lenders without generally penalties. You can't get your money back if you paid for an appraisal and those types of things. But you can switch lenders without, saying, well, you owe us money because we worked with you for 3 months, right? Those are not the kind of penalties. So you are able to switch lenders if you found a better deal. Any fees that you typically have paid prior, you can't get back. But I just want to make sure you guys are aware of that if you did have to switch lenders, they can't hold you or start charging you for the work that they've done so far. All right.
I just thought of another scenario or a situation that we had just recently. It's in regards to homeowners association or HOAs. So again, when you're trying to evaluate the cost and your ability to afford a home, make sure that you calculate in their homeowners association dues and what the amounts are. So here in Georgia, we have what's called a community association disclosure that the seller fills out to tell you exactly what the HOA dues will be in that year. But one of my concerns is that the language says estimated. So in this case, it says we estimate that your annual dues would be $4,200 a year, right? The key there is estimate. So when it came back, we received the homeowners association letter from the HOA, and it came up to $4,500, which $300 a year may not seem a lot for some, but it could be a lot for others. And so this could take you from being able to afford the home to now not being able to. So make sure that you understand, again, the full scope of things, not only the things that get you qualified, but at the end of the day, the things that will in fact, property taxes as well. If you're not escrowing, which most lenders will allow you to escrow property taxes and insurance, make sure you understand what the property taxes are or will be during the year that you own the property. And in some places, there's what's called homestead exemption, which here in Georgia, they allow you to reduce the property taxes if you let the county know that you're living there as your primary residence. So make sure that you understand the property taxes, do they include homestead or do they not? And make sure that you understand the requirements for when you're able to file, because Georgia only allows you to do it within a particular few months. And so you want to make sure that you're on top of things after you purchase the property to apply for those exemptions.
Okay, so let's answer one of these questions. All right, Jay Adams says, is it normal for a home builder to demand $50,000 non-refundable down payment just to start a contract for new construction? My answer to this one is it depends on how expensive the house is. So if it's a $500,000 house, that would be about 10% in earnest money, I guess. I've seen earnest money as high as that, but that's been as of recently because they know the risk of you walking away and they're on the hook for the supplies and the house and the construction. So I would only put that money up if you're for sure, 100% sure that you're going to buy this house, and that even if interest rates go up another percent or so, you can still afford this house because they're increasing the earnest money deposit because they know that the risks in the next few months are high for them. So they're increasing these deposits. What do you think, attorney?
I agree completely, and I laugh at or I smile at the fact of normal. Normal today is not what normal 6 months ago was, or even normal a year. And it also depends on the jurisdiction, your state. So things can be a little different. But I agree with Shahida. It also depends on the price of the property that you're purchasing. But again, what I would go back to is make sure you review the contract. So the more that's being asked of you, especially in this case, 50,000 is a lot to be non-refundable down payment. So the more that's being asked of you up front, make sure that you fully understand that contract. And so if things go sideways, in this case, it's non-refundable. So there's not much you can do, but there may be some negotiation that you can do that allow a portion of it maybe to be non-refund or to be refundable under certain circumstances. So again, make sure that you understand the contract that you're entering into. And as Shahida mentioned, make sure you understand what scenarios or circumstances could change that. And if it could change, if those circumstances change, what's that worst case scenario? Are you still able to afford that particular house?
And I would go, if I'm going to put 50,000 up, I'm probably going to at least do an hour with an attorney to look over my contract.
That's right, because you spend this amount up front with an attorney for 50,000, you're going to save that. So if the attorney reviewed the contract, or you ask the builder based on the attorney's review, and the builder says no, you've saved 50,000, even if you spent I don't know, whatever your jurisdiction is, the normal amount for an attorney to review the contract. But again, I would say have somebody competent review it. If it's a standard real estate contract, your realtor is going to be priceless. If it's a non-realtor contract, like it's a builder contract or a custom contract, then yes, have an attorney review it to make sure that it meets with what your worst case scenario could potentially be.
Yeah, like unless you're, to me, like a millionaire and it's like, a drop in the bucket to you, if the money that they're asking for in a deposit is substantial, that's more than some people make in a year. I'm going to have an attorney, I'm going to pay for whatever the hourly fee is to say, okay, I need you to review this for me, and then maybe suggest a clause that would protect me and to see if I'm protected at all. Or is my money gone as soon as if interest rates go up to 7%, is my money gone? I would want those questions answered and be able to fully understand it. So good question, Jay. All right, listen, this question. I've been under contract since August of 2021. They increased the sales price of our contract by $30,000. It's a new build, so you've been under contract for a while, so almost you're going on a year. Being under contract. They've increased the sales price of our contract by $30,000. It's a new build, and I feel that they're purposely changing the closing date so we can cancel. So that she's thinking that, okay, they've increased the price, they're pushing it back, hoping that they'll cancel and probably they'll put it on the market for even more. My thought initially is they don't really even have to do that. If they're able to increase the contract by $30,000, they can increase it to whatever the sales price is. So I don't know if they're trying to get you to cancel, because I don't see what their benefit to get you to cancel when they could change the price to the price that they want to sell it for. So what do you think, attorney?
Yeah, again, I would go back to the contract. If their contract allows them to increase the sales price based off of certain increase in cost, then that's not necessarily unusual. In fact, you'll see it more frequently now in recent new build contracts where they put in clauses that allow them to increase it because costs, frankly speaking, costs have increased, supplies costs have increased, and so they don't want to bear the brunt of that. They rather pass it over. Again, it goes back to just making sure that you're able to afford that home even there, and figure out what that worst case scenario is. You know, if they increase it another 30,000, are you still able to? And then check your contract to, well, what happens to that earnest money if they increase it? Because sometimes, you know, the give and take, and again, it's difficult to answer your question now because you have to go back to that contract. What I would suggest to those who are listening that may be entering in those type of contracts is maybe allow, if the builder allows for the sales price to increase, then maybe ask them to put in a provision that says, well, if it increased to this amount, I get my earnest money back because it's outside of what I'm able to afford. Because they should understand that when you put in a bid for this new construction home, you've done your homework, you've done your approval of the lender, and the lender is giving you sort of a cap as to what you can afford. And so if it goes outside of that, I would say make sure that your builder sort of understands it so that at the minimum, you can get your earnest money back if it goes above. Because, you know, again, we understand that the builder's not just doing it hopefully because they want to, they're doing it because they feel the same pressures of supplies increase that everybody does. But you want to protect yourself on sort of the back end to make sure that it's not increased outside of your comfort level and outside of you being able to get that earnest money back.
Yeah, because a year, if you think about it, last year you probably could have gotten a 2% or 2 something interest rate. So not only have you waited a year with interest rates rising, now they're putting on top of it a $30,000 increase. If you can get your earnest money back, I would be looking at resales while I'm in this contract because you may need to terminate on them at this point because it is still worth it to you. Now that it's at these higher interest rates and the higher price, it is still worth that build. Thank you so much for that question. And please hit the like button. I know the attorney was very busy. I was able to squeeze him in on this Monday. I'm really excited to have him here because I knew at that last live stream that, you know, we needed a legal person to kind of advise us as to what to do with our contracts, you know, in this difficult time. So let me ask this question, Michael Brown. If you have a contract closing date that has been amended 3 times, how long does a builder have to complete a build? Can a builder continue to delay a build after or is there a time limit?
Okay. Well, great question, Mr. Brown. Now, again, it goes back to the contract. So if the contract allows them to do it, then they can, regardless of whether it's 5, 10, 20 times that it's been, and you say amended. So that means, again, that it's a negotiation. That means 2 people have to agree to amend it based on that. I think what you need to, my main concern obviously would be what happens to the earnest money if we allow the builder to continue to sort of delay, again, due to sometimes no fault of their own. But if your builder is going to ask you to amend the contract, I would make sure that you review the contract to see, okay, if I'm amending these, what happens if, you know, if it either goes above what I'm able to afford, or what happens if I keep amending and I lose my interest rate with the, do I have the ability to get my earnest money back? Remember, amendments are all sort of negotiated between the parties to a certain degree. And I would look at the original contract to see if these amendments are fine and in line. And then look at the original contract to see if maybe next time you amend it, maybe amendment number 4, that you can add in a provision that allows you to get your earnest money back if for some reason you can't, based on all these extensions that are going on. Because again, the extensions are not your fault necessarily, and they may not be the builders, but they're more in the builder's control than they are in yours. And so you may have some sort of a negotiation piece to sort of limit your exposure if it goes way beyond what you can tolerate.
All right. Yeah. So you want to know when you do an amendment, they sign it and you sign it. So it's almost like a new contract that you agreed to the new closing date. So you need to figure out, like you said, review the contract. What happens if you don't agree? Like if you don't sign your part, they want to, you know, you have a new closing date, say it's June 1st. and they're unable to meet that, are they now in breach of contract? And then what is the penalty for them not closing on time? That is usually written out in the contract. So that's something you need to understand. If they want to push it past the closing date that you have now, what can you do on your end if you don't want to agree with the pushing of that closing date? You need to figure out what that is. Okay. Yes, please hit the like button, the subscribe button if you're not subscribed yet. All righty. This is a good question. I know you can answer this. Can the seller make you use their closing attorney if you have one you prefer?
It depends on whether I'm the seller's closing attorney. No.
Right.
No. So the selection of a closing attorney, especially here in Georgia, is a negotiation. I always tell everybody that. So, in this market where it's a seller's market, the seller does have more of a negotiation piece to say that you have to use our closing attorney. But at the end of the day, it's a negotiation. So if you are saying that I'm giving you more value than the next buyer, but I prefer to use my closing attorney, you can write that in there. But in some cases, again, because the market dictates who has a better bargaining chip, and because in this case, sellers are primarily dictating contracts to accept, then most of the time you end up using who the seller. And in some cases, the seller has no preference. But in the cases that the seller has a preference, it typically will go to the seller. But the short answer is it's negotiable.
Okay. But usually, typically, and again, this is negotiable too, but in most cases, the buyer is paying for the closing attorney, because if they're having it financed, it's their lender, because the closing attorney in most states are going to represent the lender. They don't represent either side, but because you're bringing the lender, because you're financing the deal, a lot of times the closing attorney costs fall on the buyer, not the seller.
Yeah, and it could be a negotiation. So if your preferred attorney will charge you less than maybe the seller's closing attorney, that's a negotiation piece. You could provide it to the seller and say, hey, I know you're paying some closing costs, you're not paying all. So if your seller's attorney will match my attorney, then I'm fine with using your attorney. So again, it's a negotiation. At the end of the day, it's helping you sort of gain sort of traction with this contract.
Okay. AQ, thank you both so much for the feedback. Thank you for joining us. Our closing is set for September now. We were supposed to close in March. So yeah, there's a lot of, especially with these builders, there's a lot of delays. And then the delays, and this I think, to me, this is the fastest interest rates have increased. I mean, there was one rate you get in February, March, April, the rate almost doubled for a lot of people. So, you have to react to it and react a little bit differently, and make sure you're doing your due diligence, because everything got more expensive for you very quickly as well. So just make sure that.
I would do a cost benefit analysis, and some lenders will allow you to extend a rate lock, and it may cost you some money to extend it, but over the 30-year life of the loan, it may mean that it'd be cheaper to extend your lock now, because it will save you in the long term. Now, I don't know. I'm sure most lenders can't extend a lock from March to September, so I don't know what to say there. But that's wow. I mean, fortunately that's unusual, but I do see that happening.
All right, let's answer this question from Alice. Under contract, hi Alice. Under contract for a house, didn't put any money down, as is sale, inspection failed. Can I change contract to reduce price? Or can I still walk away? So I guess she didn't put any money down, or any earnest money, I guess. As is, inspection failed. I know what the attorney's going to say. It depends on what's in the contract.
Well, congratulations, Alice, on getting a contract where you didn't have to put any money down. That's great. So if you're in like Georgia, for instance, where your only liability is that earnest money, then it appears that you can walk away, because there's nothing again, assuming that there was nothing additional that the seller did on your behalf during that phase. But yes, I would say that yes, I would, and yes, you could negotiate a reduced price based on, again, even though it's as is can always be negotiated, because you found things in the inspection that reduce the value of of that property. And so you can, and yes, you should be able to walk away, again, making sure you review the contract to see what your liability could be under that. But in most situations, you should be fine.
And let's talk about as is for a minute, because I think as is scares people. Like sellers put as is. As is their hope to sell the house as is. But there's nothing stopping you from requesting, depending on the contract or whatever, there's nothing stopping you from requesting repairs or requesting a credit. That is what they hope to sell the property for. But if they can't find anybody to buy it as is, I bet they'd be willing to negotiate with you. So don't assume just because they said it was as is, they're not willing to give you a credit to sell the house. They're not willing to repair something to get the house sold. That is, to me, their hope, to tell people ahead of time, we want to sell this house as is. But when they're, when you have your inspection, you're still willing to buy it, but you're saying, I want the air conditioning replaced, you have to at least go back to them with that, offer or that counter offer to say, I want your house, but this is what I want in return. And they could either deny that and say, no, I truly want to sell it as is. But in a lot of cases, the seller will consider that that renegotiation or that credit or that repair to get their house sold. So when I see as is, I see that as the hope of the seller, that they want to sell their property without, making repairs. But it's still open to the buyer to, to request repairs or a credit. That's something you still can do. It doesn't stop you from doing that.
And Shahida, this question actually reminds me of a scenario when we talked about, do you see scenarios in the office? So what I've seen sometimes is where buyers are putting in offers and they're trying to get the best offer. They'll reduce or they will zero out their due diligence inspection period, and I think that does a disservice to them, because if you're trying to make your offer sort of the best offer, I wouldn't take away from your due diligence. That is sort of your livelihood, your ability to walk away if inspection fails or if inspection identifies an issue that, again, will cause you to end up spending more than you're able to afford in a house. So I would recommend buyers, even in this type of a market, don't negotiate away your due diligence period. If you reduce the amount of that period, make sure that you've done your homework ahead of time to prepare people so that if you went from a 14-day due diligence period to a 7-day, make sure that you have all your subs, your inspectors, and people lined up so that on day one of acceptance of the contract, they're ready to give you sort of their opinion on the condition of the property.
Okay, very good. I'm trying to go through this. I want to put this up here because AQ, we answered this question earlier. He said he did an extended rate lock to keep our rate at 2.6, but our rate expires in July. Hopefully our lender will let us continue the extension until closing. Okay, I'm done hogging the chat. Thanks again. But that's good to know that he was able to extend. This is the viewer that asked a question about, they were scheduled to close in March and now they're closing in September. Yeah. So he does have a rate lock, but you have to see if they're going to allow that to extend past July.
Yeah, and I would ask, I'm sure he's already done this, he or she has already asked this question, but I would ask it now. Especially if is this the same?
I think this is the same. Yeah, it's the same question asked about in September. Yes.
So I would go back to your lender now and say, well, what happens? Can you extend my rate lock to September? I would ask now, because maybe now they can do it, but it may cost a little bit more money now as opposed to asking them in July to extend it to September, when they either may not be able to or it would cost more at that point in time. So if you know now that it's going to be extended to September, I would go to your lender and say, hey, what's it going to cost me to extend my rate to September?
Okay, great question and good luck. That's a great rate.
Yeah,
I mean, those 2.6s. I don't know if we're seeing any more 2s lately. Have you seen any? Have you seen any 2s like closing deals this month?
No, I have not. I've only seen some 3s and 4s only because they paid points, discount points to reduce the interest rate. But I've not seen a 2.
Not seen those 2s since 2021. Thank you so much. All right, I thought I had a question was good. Okay, this is a good one because a lot of people are scared about this. What is the best way to do a concurrent closing? So, and what they're talking about is they're selling their house and trying to buy a new one. But a lot of times you have to pay off your first house. A lot of people can't hold two mortgages. So they have to have their first house paid off before they can go to close on their second house. Now, I've seen it where people close in the morning, if it's done perfectly. They close in the morning on the first house and they close in the evening or afternoon on the second house. Yeah. What is the best way that somebody can close and not be homeless, just in case one of them doesn't work out?
Well, I mean, so you have to plan, because even the best laid plans are going to end up maybe not falling exactly in order. So the very first thing I would say, obviously, again, goes back to the scenarios that you tend to see. Sometimes you tend to see where you and your agent do not put in what's it called? A sale contingency, where you have to sell your house before you can purchase their house. So sometimes you forget to put those contingencies in there. But what I would say is make sure you have that contingency clause in there that allows you, if for some reason the sale of your home falls through, that you can walk out away from the sale of the home that you want to buy, because you have a clause in there that says it's contingent on you selling your home. So assuming you have that clause in there, the key thing is just continuous communication, making sure that you communicate with all parties, that one has to occur before the other so that they can understand. Because we, as closing attorneys, for instance, if I'm doing the second transaction and I know that it's based off of the first, I plan accordingly and I notify my lender that it's making sure that we get everything in time so that it allows you to sell. But again, worst case scenario, always plan for those. So if you have in-laws or relatives that you can spend some time with, or you have a U-Haul, make sure you understand that U-Haul, extend that, because if your U-Haul needs to be outside of your old or new home for 1 or 2, 3 days, or even weeks sometimes, plan for it. Plan to get a storage unit that you can get in case you need to take your belongings there. Because I've seen it in closings where that has occurred because of the second transaction's been delayed, or even the first has been delayed. And so you just have to plan accordingly to make sure.
Okay. We're in the final stretch. We have Attorney Barley for an hour, so we have about 15 more minutes. This is not really a legal question, but I want to clarify this one for everyone. So, and then Attorney Barley, you can probably add on to this because you have everybody sign the amortization schedule at closing.
Right.
It says, can you clarify the 30-year amortization period? For example, at the end of the first 5 years, does a mortgage automatically renew for the next 5 years at the same rate as the previous 5 years? This is my understanding of the 30-year. It tells you your payments, your everything for 30 years. And, if you make all of these payments over the 30 years, everything will be paid off at the end, like the last 30-year payment will be paid off. There's nothing that renews after the 5th year that I'm aware of, unless you have like a 5-year ARM or something along those lines. But if you have a 30-year mortgage, it goes over, if you make your payments, it'll tell you every payment you need to make in order to pay that mortgage off. What are your thoughts?
Yeah, and that's exactly, well, I thought I had the good answer to the question until I read the second part. So assuming you have a 30-year mortgage that is amortized, meaning that the interest is calculated over that period of time. So if you have a 30-year mortgage that's amortized over that 30-year period, that same period, then fine. It's set, it's a fixed rate for that 30 years. Now, if you have a mortgage that's less, like you could potentially have a 5-year mortgage that's amortized over 30 years. That means, although it's a 5-year mortgage, the interest rate has been calculated for 30 years. That means that at the end of the 5 years, you're going to have a balance because they calculated the interest over a 30-year period as opposed to the 5 years. Now, it depends on the mortgage, the note. So if it says that there's an automatic renewal, then yes, it'll automatically. But most of the time, what you'll see is those are what's called balloon notes. That means that at the end of the 5-year period, a lump sum amount is due to your lender. Now, your lender can negotiate and renew it. You'd have to qualify again in some situations, or they may have a clause that allows you to renew it. But in most cases, you have to get ready to sort of refinance or restructure that mortgage before that period is over. So it really just depends on the type of loan that you have.
Okay. Thank you so much for that question. I'm gonna put this on there real quick. Please watch my video on points and how your mortgage lender is quoting you these rates so you can better understand it. Big Gucci Sosa says, "Hey, Ms. Hill, thank you. Thanks to you, I was able to save $5,000 by asking for the par rate. The par rate is the rate without points. So you want to know what that is, because some lenders will automatically quote you a rate with points, and they won't even tell you they're quoting it with points. But when you see your fees, you'll see that, oh, these fees are increased. And he did save, I guess, from a 4.1% to a 4.0, but you're saving maybe $5,000 that you don't have to come to closing with. So you want to know what your par rate is without any points. But I have a video on points specifically. It's not too complicated because it can get complicated. But yeah, you want to ask your lender, especially in this market, what is my rate without any points? And then you decide whether you want to pay points. You either can pay points, right? Or you can pay a higher interest rate and get a credit at closing. So you need to make sure you understand that, because a lot of lenders don't take the time to explain that to you. So you want to make sure. Do you have anything you want to say about points?
Yeah, in addition to that, what I explain to clients at closing tables sometimes is also understanding what the APR is, the annual percentage rate, because the APR is different from your interest rate. So most of the time you have the tendency to want to compare interest rates between lenders, but that's actually not correct. What you need to be doing is comparing the annual percentage rate, the APR, because that adds in the cost of the loan. And so those are the best way to do an apples to apple comparison and understanding which is offering you the better interest rate.
Okay, so don't look at the interest rate, because that's the one that they're trying to show you. Like ours is the lowest, but they're not looking at all the fees that they're charging you. So when you're looking, like you said, if you want to look apples to apples, you want to look at APR for the one lender versus the APR of the other lender. Don't just look at the low rate, because there's probably some fees in there to get that lower rate. Like, let's talk. We'll take this question from Open Door, or this Open Door question. All right, Holly Mo. Hi, Shahida. I want to sign a contract with Open Door, but the finalized selling price is not included in the contract. Is that normal? I would say no, and I wouldn't sign a contract where there's no final price.
Correct. Yeah, because even builders contracts that allow for, they start somewhere, and so I would say yes, do not sign a contract if you don't. Most standard contracts, the very first page has the most important terms, and the selling price is probably hands down the most important of all terms. And so there should not be a contract where you don't sign it, where you don't have the selling price. And if that's the case, make sure you negotiate and add a special stipulation that says this is the max selling price that I can, because again, it could be based on that. They're trying to understand the market or the valuation. But understand what your max is so that you don't get quoted at the end of the day higher than what you're able to afford. So,
and all Open Door homes are resales. They're not new construction that I know of. So if you're doing a resale Open Door home, they should have a firm price, or whatever you offer becomes the price. So if you offered a certain price on an Open Door home and they sign that contract, that becomes the final sales price, or that becomes the agreed upon price. So you need to make sure.
They may have sent you a sample contract to review or look over that doesn't have the price in there, and that's what your offer is the dictating of what that price is going to be. But I would be very concerned with the contract that does not have the price in there.
Okay, thank you for that question. All right, let's talk about these escalation clauses again. So it says, tell us about escalation clauses. Basically, when the builder's allowed to increase the price. How can I avoid such clauses? First of all, you have to know that they're there, right? So they need to read these contracts, to make sure that they understand if there's an escalation clause in there. Because will they even call it escalation clause? Like, what would they say?
Yes, in most, I would say in builder contracts, they wouldn't call it escalation, because I think as people get more savvy and understand what they're looking for, they're not doing it intentionally, but they're not going to highlight what the clause is. You have to read and understand that this is an escalation clause. So again, make sure you understand that if it's there, that it's there. Make sure you understand how high it can go up to if at all, if it dictates that. Make sure you understand, or that you put in there, if there's an escalation clause, how can I get my earnest money back if it goes above what I'm able to afford? Because you should be frank and upfront with this builder, whomever, understanding what your costs are and what you can afford. And if this escalation puts that above it, then that may be fine from a builder standpoint, but you've been notified, and so yes, if it goes above 350,000, then I get my earnest money back. And so it's not necessarily how do I avoid it, but how do I approach it, or how do I make sure that I'm addressing it before I sign the contract.
Yeah, and don't be afraid for realtors that are in the chat and for buyers that are in the chat, especially with builders. Don't be afraid to ask that a clause be put in. All they can tell you is no, right? I've had clauses where I knew the client was getting down payment assistance, and they wrote the clause in: if this client does not receive down payment assistance, they can terminate and get their earnest money back, because I knew she could only buy the house if the down payment assistance was approved. So I asked the builder, I said, I want this clause to be added, and they were able to add that clause in for me that she could walk away if her down payment assistance, and she was using the preferred lender. So if if they couldn't get the down payment assistance approved, then she could walk away. But those things you're going to have to ask for. They're not going to give it to you, right? They're not going to, and they're not going to sign all the time your contract. So you're going to have to ask them to add those clauses to their contract. But if you don't ask, you're never going to get it. So you need to make sure that your realtor or you are asking to put these types of limits, or, I get my earnest money back if this happens. You're going to have to ask. And if they're not willing to do it, then you need to think about walking away, to say, okay, I'm not willing to risk $50,000. I'm not willing to risk $35,000. And you have to be able to walk away from that builder. Builders are, as interest rates rise, builders are getting more and more flexible in what they're willing to do, because they're not at a point where they have these long waiting lists. They're calling the people on their waiting list, trying to get them to buy these houses now. But before, they had these long waiting lists and everybody was fighting for these houses. It's not like that anymore as much, okay? So because interest rates have risen, a lot of people have gotten off those waiting lists and they're not buying. So the ball may be back in your court, maybe not 100%, but they're not as, interest rates aren't 2%, 3% anymore, where they have everybody wanting to buy. Some people can't afford to buy a new construction home anymore. So if you're still able to buy at these higher interest rates, don't be so, don't think that these builders have so many buyers that they used to have. They don't have these large amounts of buyers that are begging to buy these houses anymore. In some markets, but they may make it appear that they do. They may make it appear that they're still at that same space, but they're not. Okay, so you need to make sure that if they're calling you, or if they're, if they're looking for you and calling your agent. I've had the first builder call like in the last last month. I got a builder calling me asking my client when they were coming back. That hasn't happened like in the last 2 years, because they didn't need to do that. But now they're actually following up because they don't have as many people that are like waiting to buy their home. So just make sure you are paying attention to that. All right, let me see. Thank you so much, everyone. Kenneth said I'm really glad I turned in, really helpful as I plan to buy a home. Thank you so much. Let's talk about where the APR, where can they find the APR?
It should be in your pre-approval document. If it's not a simple request to your lender asking for it is sufficient, but they should tell you what that annual percentage rate is.
Okay, yeah. So make sure you're looking at that APR, and they quote both, like your interest rate, your standard interest rate, and they quote the APR. And let's make this our last question for the night. Please hit the like button if you want Attorney Barley to come back. He's going to be having a YouTube channel, and he did and we'll have him talk about that a little bit. His your planning, your legacy. We did our legacy video about making sure you had a will and a trust and having all of those things in place. So we have a video on the channel together already. So make sure he's going to talk about that a little bit, because he does real estate closings and he also does estate planning. So you want to make sure that you have watched that video. Some really good information on that as well. But Michael Brown is back. So we're going to end on his. He said, what happens when the interest rates have increased above the finance contingency rates outlined by the builder or preferred lender. So basically you have one interest rate in your contract, and now the interest rate is above that amount.
So again, depends on the contract. But if the contract says that you are qualified, or you are to get a rate based on this amount or this, then and it goes above that, then you should be able to cancel that contract. But again, it depends on that, because in addition to the interest rate, there's also a time limit that's placed on there to avoid having a too long of a time period that allows rates to increase. So you have to look at the provision in its entirety to see what other restrictions are there to that increase. But if it's just an increase in rate and you're within that time frame, in most cases, you're able to walk away with your earnest money. You just have to read the contract to see what you need to provide to the builder or to the seller that allows you to do that. Because sometimes they'll need to get a letter from your lender or some other documentation there. So the short answer to your question is to review the contract to make sure that in its entirety, it's not only an increase in rates, but some other variable that needs to be taken into consideration.
And a lot of the preferred lenders for the builders are quoting you at a higher interest rate in preparation for interest rates rising. So they're putting in, if interest rates right now are at 5.5 or 5.25, they're quoting a 6% rate. So they're making sure that you can't possibly get out for that finance contingency because they're saying, well, no, you qualify still at a 6%. So just make sure that if you're not comfortable with that, tell the lender, no, I don't want to go above 5.5. So you want to make sure that you're having those conversations. When they're filling in those blanks, make sure you understand what those mean. Tell them, attorney, how they can reach you. Tell them about the estate planning and the closing attorney. Sure.
Well, as Shahida mentioned, I only do two things here. I try to not to be a jack of all trades. So I do estate planning, wills and trusts, and I do real estate transactions, residential transactions. I currently am managing the offices for a large firm. So I manage the Conyers, Covington, and Stockbridge offices in Georgia. But because of our footprint, we're able to close in any of the metro Atlanta cities. So we have that footprint here. My contact information, if you like, my office number is 770-602-9924. Again, that's 770-602-9924. The best email is my office email. So if you remember that my office is in Conyers, it's Conyers@Lueder Law, the name of the firm. So LUE as in Edward, D as in dog, ER law.com. So Conyers@LuederLaw.com.
And I will make sure everything is in the description of this video. If we did not get to your question, I will, be answering them as the week progresses. If we miss something, put it in the comments of this video though. I want to go through this real quick because I saw this. So what can I do if I find out that the builder tried to hide clauses? How can they hide it if it's in writing? So it's not that they're hiding it, is that you don't know what you're looking at. And that's when I think, when you say like they're trying to hide something, what's your advice for that?
Well, I mean, the only way to hide it is one, by not bolding it and giving it a title, or by making the print a little bit smaller than the others. But again, if you go into a contract review with the intent to review every single line in that contract, even if it means highlighting it once you reviewed it, or having your realtor do it or an attorney do it, then at the end of the day, there's no way that they can hide any provision there. The only way that they can hide it is if they either to make the language ambiguous so that a layperson, a regular layperson, won't understand it, in which case, again, more reason for you to get an experienced or detail-oriented realtor, or you get an attorney to review it for you. But other than that, there are no ways that I know of to hide clauses in contracts.
Yeah, and get the contract. If you're thinking about new construction, get a copy of the contract ahead of time from the builder so you can review it so nothing is hidden. Because you cannot, let's say this really quickly, attorney, they can't come later and say, well, I didn't understand it.
Correct.
You can't say that. You have to be able, if you sign something, it's understood, as long as you are a fair mind, and clear body and over 18, that you understood what you were signing.
Yep. And that's a perfect question to sort of recap recap what we've talked about here. At the end of the day, make sure you review everything that you've signed If you don't understand it, make sure you ask, because again, at the end of the day, you're going to be held responsible for whatever you sign. And so make sure you ask your real estate agent or you ask an attorney, but at the end of the day, make sure you understand what you sign and understand your worst case scenarios. If your worst case scenario is not in the contract, ask for it to be entered into the contract. Worst case scenario, they'll say, hey, nope, sorry, we can't do it. And at least you'll know up front, okay, this is something that I need to be aware of because it's not being added into the contract.
Right. And then last thing, I just thought about this. A lot of times when you're dealing with builders, they want you to sign the contract first, and then you sign the and then they sign the contract next. So you're like the first person to sign, then they're the second person to sign. If you change your mind before they sign their section, you don't have a binding contract. You can a lot of time withdraw that contract. So if both sides don't sign the contract, it's not a binding contract. It's just an offer at that point. Yeah. So if you've made an offer and the other side has not signed it yet, and you change your mind or you realize something you weren't aware of, then you could withdraw that contract before they sign. And I've done that before with people who just, they thought about it, the builder hadn't signed it yet, and we withdrew our offer. So just because you signed a contract, if they haven't signed it yet, it's just an offer. It is not a binding contract until both parties sign that contract. So just be mindful of that as well. Hopefully this was helpful. Hey, Christina, I see you there. Thank you so much for joining us tonight. But thank you again, Attorney Barley. All of his information will be in the description. I hope this helped you guys tonight to know, to get prepared, because everything is going to be volatile. We don't know where interest rates are going to be, especially over the summer. The Fed meets in June. The Fed meets in July. So you want to make sure that you are prepared for what can come up after this. All right. Thank you, guys, and have a great night.
Thank you. Bye-bye.